Imagine earning billions of dollars, operating in more than 100 countries, using roads, courts, educated workers, and public infrastructure, and still paying almost zero tax. No hacking, no fraud, no crime, completely legal. Today, I will show you the 7 legal strategies multinational corporations use to reduce their global tax bill and why governments struggle to stop them. By the end of this video, you will never look at corporate taxes the same way again. This is not theory. These methods are used by some of the largest companies in the world, and they form the backbone of modern international tax strategy. Let's break them down in simple terms. The first strategy is called deferral. Imagine you are a company based in a high-tax country. You earn profits abroad. Normally, when you bring that money back home, you should pay additional tax. But here is the strategy. You simply do not bring the money back. Instead, you keep the profits parked in a low-tax jurisdiction. As long as the money stays overseas, the extra tax can be delayed, sometimes for years. The result is billions, even trillions, sitting offshore. The second strategy is transfer pricing. This is one of the most powerful tools in international tax planning. Imagine 2 companies owned by the same parent. One is located in a low-tax country. The other is in a high-tax country. They trade goods or services with each other. Now here's where it gets interesting. The price of that transaction is decided internally. If the price is increased, more profit appears in the low-tax country. If the price is lowered, profit shifts elsewhere. Nothing physically changes. The factory is the same. The product is the same. Only one number on the invoice changes, and that single number can shift millions across borders. The third strategy is royalty payments. Today, most corporate value does not sit in buildings or machines. It sits in patents, trademarks, software, and brand names. A multinational company can move its intellectual property to a subsidiary in a low-tax country. Then, every other subsidiary must pay royalties to use that intellectual property. Those royalty payments reduce taxable income in high-tax countries, and the income appears in the low-tax country instead. It is perfectly structured. The fourth strategy is intracompany loans. Governments usually allow companies to deduct interest payments as an expense. So, multinational groups create loans between their own subsidiaries. A subsidiary in a low-tax country lends money to a subsidiary in a high-tax country. The high-tax subsidiary pays interest. That interest reduces its taxable profit. And once again, profit shifts legally within the group. The fifth strategy involves overhead allocation. Headquarters spends money on research, branding, global management, and technology systems. Those costs must be allocated across different countries, but there is no single universal formula for how to divide those costs. So companies may allocate a larger portion of expenses to countries with higher tax rates. When expenses increase, taxable profit decreases. The sixth strategy involves tax havens and shell companies. A shell company may have no employees and no real operations. It may exist only as a legal entity, yet it can hold patents, receive royalties, or store profits. These entities are often located in jurisdictions with very low or zero corporate tax. They serve as parking spaces for global income. The seventh strategy is called a corporate inversion. This happens when a company based in a high-tax country merges with a smaller company in a lower-tax country. After the merger, the headquarters is legally located in the lower-tax jurisdiction. The operations may remain the same, the employees may remain the same, but the tax rate changes. Some call this smart strategy, others call it unfair. And this brings us to the bigger question. Are these strategies illegal? No. Are they unethical? That depends on your perspective. From a corporate viewpoint, executives have a fiduciary duty to maximize shareholder value. If the law allows a structure, they use it. From a government viewpoint, companies benefit from public infrastructure and should contribute fairly to society. This tension defines modern global taxation. There is no world tax authority. There are more than 190 separate countries, each with its own rules. Multinational corporations see the world as one economic system. Governments see borders. Between those two realities, billions are shifted every year. Understanding these 7 strategies is not just about tax. It is about understanding how global business truly operates. Because in multinational corporations, tax is not an afterthought. It is built into strategy from day one. If you found this insightful, subscribe for more international tax insights. And tell me in the comments, is this intelligent business strategy or a system that needs reform?
They'll have a fair chance.